Good morning. First of all, I would like to introduce myself to all of you here. I am Julia Safitri. My student ID is 1810426414. I'm from Accounting Class B. I take Accounting English from Mr. Adi Mursalin. In this opportunity, I would like to answer the question given my lecture, Mr. Adi Mursalin. The question consists of the parts, namely Part A, which is related to the accounting theory and its practice. Part B, which is related to videos of company of accounting. And Part C, which is related to accounting article. Well, I start to answer the question in Part A. Number 1, what is accounting? Write the definition of accounting to 5 experts. Definition of American Institute of Certified Public Accountants. Accounting is the art of identifying, recording, classifying, and summarizing in a significant manner and in terms of money transactions and events which are, in part at least, of a financial character and interpreting the result thereof. Definition of Warren Reef. Accounting is an information system that provides report and stakeholder about the economic activities and condition of a business. Definition of Donald Caso. Accounting might be best defined as identification, measurement, and communication of financial information about economic entities and interest persons. Identification of Arnold. Accounting is a system that provides information to anyone who must make decisions and control the implementation of those decisions. Definition of Abu Bakar and Libobo. Accounting is an information system that recognizes and records financial transactions that presented and financial statement. Number 2, what is accounting cycle? And expand in details the cycle or the stage of accounting cycle. What is accounting cycle? The accounting cycle is the historic process of recording and processing of financial transaction of a company, from when the transaction occurs to if representation on the financial statement to closing an account. Stage of accounting cycle. Transaction. Financial transactions start the process. If there are no financial transactions, there will be nothing to keep track of. Journal entries. With the transaction set in place, the next steps is to record these entries in the company's journal in chronological order. Posting to the journal ledger. The journal entries are then posted to the journal ledger, where a summary of all transactions to individual accounts can be seen. Trial balance. At the end of the accounting period, which may be quarterly, monthly, and yearly depending on the company, a total balance is calculated for the account. Worksheet. When the debits and credit on the trial balance don't match, the bookkeeper must book for errors and make corrective adjustments that are checked on a worksheet. Adjusting entries. At the end of the company's accounting period, adjusting entries must be posted to account for accruals and deferrals. Financial statements. The balance sheet, income statement, and cash flow statement can be prepared using the correct balance sheet. Closing. The revenue and expense account are closed and zeroed out of the next accounting cycle. Number 3, mention is accounting equation and explain the components of accounting equation. The basic accounting equation is also called the balance sheet equation. Is the relationship between assets, liabilities, and equity of the owners of a business. Basic accounting equation is the basis for bookkeeping in pairs. The basic equation component includes assets, liabilities plus equity. Assets are resources owned by the company and its economic benefit for the future. Liabilities is an obligation that must be repaid by the company from the consequences of past transactions. Equity is the residual value of assets owned by the company after deducting liabilities. Number 4. What is account and what are the use of accounts in accounting equation? An account is a record in the general ledger that is used to sort and store transactions. For example, companies will have a cash account in which to record every transaction that increases or decreases. The company's cash another account shall will collect all of the amounts from the sale of merchandise, and most accounting systems require that every transaction will affect two or more accounts. For example, a cash sale will increases the cash account and will increases the sales account. Number 5. What is the purpose of accounting? The purpose of accounting is to accumulate and report on financial information about the performance, financial position, and cash flow of a business. This information is then used to reach decisions about how to manage the business or invest in it or lend money to it. This business or invest this information is accumulated to accounting record with accounting transaction, which are recorded either through such standardized business transaction as customer invoicing or supplier invoice, or through more specialized transaction known as journal entries. Number 6. What are assets, liabilities, and owner's equity? Assets are resources that are controlled by the companies as a result of past events, and where the future economic benefits are expanded to the obtained by the company. Liabilities are current comparable liabilities arising from past events. Their completion is expected to result in an outflow of company resources controlling economic benefit. Owner's equity is a residual right to a company's asset after deducting all liabilities. Number 7. What is business transaction? A business transaction is an activity or event that can be measured in terms of money and will affect the financial position or operation of the business entity. Revenue is the amount of money obtained or received by the company caused by an activity, generally the result of the sale of product or service. Expense payment or this fine or future obligation in order to obtain some profit. Withdrawals is taking fund by the owner of the individual company for personal purpose that will reduce capital. Number 9. Explain the steps for analyzing the business transaction. Determine the effect of a transaction on asset, account, liability, owner's equity, including income and accounts. Determine the effect of the transaction on each account, whether the account has increases or decreases. Determine whether the increases or decreases in the account must be recorded next to the credit or next to the debit. Number 10. Mention 6 business transactions happening in a company, their business transaction analysis. The owners, Mr. Andre, invested IGR to 20 million rupiah in cash and IGR 15 million rupiah in equipment. Cash increases IGR 20 million rupiah. Equipment increases IGR 15 million rupiah. And equitas decreases 35 million rupiah. Purchase equipment IGR 4,500,000 rupiah. Paid in cash of IGR 2 million rupiah. Received approved credit. Purchase equipment increases 4,500,000 rupiah. Cash decreases 2 million rupiah. Received decreases 2,500,000 rupiah. Completed consultant service of IGR 80 million rupiah. Received in cash for the remaining 3 million rupiah in credit. Cash increases 3 million rupiah. Receivable increases 5 million rupiah and income decreases 80 million rupiah. The owner withdrew IGR 1,500,000 rupiah in cash from the business for personal use. Price increases 1,500,000 rupiah. Cash decreases 1,500,000 rupiah. Parent amounting to IGR 3 million rupiah. Rent expense increases 3 million rupiah. Cash decreases 3 million rupiah. Paid the following wages expense 400,000 rupiah. Miscellaneous expense 100,000 rupiah. Wage expense increases 400,000 rupiah. Miscellaneous expense 100,000 rupiah. Cash decreases 500,000 rupiah. Number 11. Cash $1,000. Account receivable $3,200. Merchandise inventory $850. Land $10,000. Account payable $1,530. Number 1. Cash increases $3,928. Income decreases $3,928. Number 2. Account payable increases $1,055. Cash decreases $1,055. Number 3. Cash increases $3,700. Sale capitals decreases $3,700. Number 4. Rent expense increases $1,200. Cash decreases $1,200. Number 5. Account receivable increases $2,025. Income decreases $2,025. Number 6. Store supplies increases $245. Cash decreases $245. Number 7. Cash increases $3,000. Income decreases $3,000. Number 8. Account receivable increases $1,635. Income decreases $1,635. Number 9. Wages and salaries expense increases with $850. Utility expense increases $325. Service expense increases $220. Other operating expense increases $75. Cash decreases $1,500. Supplies expense increases $865. Store supplies decreases $865. Price increases $1,000. Cash decreases $1,000. Trial balance. Cash increases $7,683. Account receivable increases $6,860. Merchandise inventory increases $850. Store supplies increases $620. Land increases $10,000. Income increases $10,588. Account payable increases $475. Sale capital increases $13,520. Rent expense decreases $1,200. Service expense decreases $250. Wages and salaries expense decreases $850. Utility expense decreases $325. Other operating expense decreases $75. Price increases $1,000. Income statement. Net profit $7,888. Statement of change in capital. Final capital 31 of July $6,632. Balance Activa $25,638 and Passiva $7,107. Part B. In this part, the question of related to the accounting video. I will answer the question based on the following instruction. Number 1. What is the title of the video? And title of the videos is Chapter 1, Principle of Accounting. B. Who is speaker in the video you watch? The speaker in the video I am what is Mark Christopherson. C. What does the video tell you? That video tells about principle of accounting. D. Explain the contents on the titles of the video you watch. First, the purpose of accounting, among others, identify, record, and communicate the economic event of an organization to interest user. Three activities in accounting. One of third is identification. First, we do identification. After that, we can enter to recording, classifying, and summarizing the prepared accounting report by communication with analysts and interpret for user. The accounting process includes the bookkeeping function. There are two boards, groups, user of financial information, among other internal user and external user. The internal user, there are management, human resource, financial, and marketing. In external user, there are IRS, investor, labor, unions, creditors, SIC, and customer. Ethics in financial reporting standard of conduct by which one's actions are judged as right or wrong, honest or dishonest, fair or not fair are ethics. There is a referring question. Ethical are the standard of conduct by which one action are judged as A. right or wrong, B. honest or dishonest, C. fair or not fair, D. all of these options. The answer is D. all of these options. Next, chapter 1 to 7. Various users need financial information. Financial statement, balance sheet, income statement, statement of the owner's equity, statement of cash flow, not disclosure. Generally accepted accounting principles. The accounting profession has attempted to develop a set of standards that are generally accepted and universally practiced. Chapter 1 to 8. There are organizations involved in standard setting which one is Securities and Exchange Commissions. Forms of business ownership are proprietorship, partnership, and corporation. The basic accounting equation: assets equals liabilities plus owner's equity. There are two variations on basic accounting equation. Among other, assets minus liabilities equals owner's equity. Allow asset minus owner's equity equals liabilities. Using the basic accounting equation, transactions are a business economic event recorded by the accountants. May be external or internal. Not all activities represent transaction. Each transaction has a dual effect on the accounting equation. A. What are the benefits for you watching the video? The benefit for me are knowing the purpose, principle, and career opportunities in accounting. Number 2. What is the title of video? The title of video is Chapter 1, Reviewing of Accounting Equation and How Transactions Affect the Equation. B. How to the speaker in the video you watch. The speaker in the video I am watching is Mr. The Price SHS. C. What does the video tell you? The video tells the basic accounting equation, review of accounting equation, and transaction affect the equation. D. Explain the contents in the detail of the video you watch. First, the speaker said the basic accounting equation. The accounting equation is considered to be the foundation of the double entry accounting system. The accounting equation shows on a company's balance sheet whereby the total of all the company's assets equal the sum of the company liabilities and shareholders' equity. The formula for the accounting equation is asset equals liabilities plus owner's equity. The balance sheet holds the basic of the accounting equation. Look at the company total asset on the balance sheet for the period. Total all liabilities when sold be a separate listing to the balance sheet. Look at to shareholder equity and add the number to total liabilities. Total assets will equal to the sum of liabilities and total equity. The accounting equation helps to assess whether the business transactions carried on by the company are being accurately reflected in these books, and accounts below are explains of items listed on the balance sheet. Assets include cash and cash equivalents or liquid assets, which may include treasury bills and certificates or of deposit. Accounts receivable are the amount of money owed to the company by its customer for the sale of its product and service. Inventory is also considered an asset. Liabilities are what a company typically owes to needs to pay to keep the company running. Debt, including long-term debt, are liabilities as well as rent, tax, utilities, salaries, and wages, as well as dividends payable. Shareholders' equity is a company total asset minus its total liabilities. Retained earnings are part of shareholders' equity and are equal to the percent of net earnings that were not paid to shareholders as dividends. A. What are the benefits for you watching the video? The benefit for me is knowing what is accounting equation, knowing transaction affect the accounting equation, and also know how to calculate the accounting equation. Number 3. What is the title of video? The title is video is how to do a balance sheet. B. Who is the speaker in the video you watch? The speaker in the video I am watched is Superfast CPA. C. What does the video tell you? The video tells about balance sheet. And D. Explain the contents in the titles of the video you watch. The video tells the balance sheet of a scammer company on December 31, 2011. Part 1 of 4. Setting up your balance sheet. 1. Use the basic accounting equation to make a balance sheet. This is assets equals liabilities plus owner equity. This balance sheet has 3 sections. Asset, which are the resources, owner liabilities, which are the company's debt, and owner's equity, which is contribution by shareholders and the company's earning. The information needed, the company balance sheet can be found, and the company's general ledger, where all financial transactions for a particular period will have been recorded. A balance sheet, the total sum of assets must equal the sum of liabilities and owner's equity. Number 2. Choose the date of the balance sheet. The balance sheet is created to show the asset, liabilities, and equity of a company on a specific day of the year. Usually, companies prepare an official balance sheet quarterly, the last day of March, June, September, and December, for example, and at the end of the fiscal year, such as December 31, but it can be done at any time. You might not finish putting together the balance sheet until several weeks after the end of the fiscal years. But your data collection and the balance sheet that would still be December 31. Number 3. Prepare the header of the balance sheet. Use the title balance sheet at the top of the page. Beneath it, list the name of the organization and of effective date of the balance sheet. Part 2 of 4. Preparing the assets section. List all current assets. Current assets are assets that can turn into cash within 1 year of the balance sheet date. They are listed in order the relative liquidity, in others words how easily they could be converted to cash. Number 2. List all non-current assets, also known as long-term assets. Non-current assets are defined as a company's value is property, plant, and equipment that can be used for more than 1 year minus depreciation. The general ledger will indicate the current value of long-term assets. Number 3. Include any intangible assets. There are also considered non-current intangible assets referred to non-monetary assets that have no physical substance and will last more than 1 year. This includes patent, copyright, trademarks, and other rights. Non-tangible assets will have a value in the general ledger to establish costs. Number 4. Add up the current and non-current asset totals and label this amount total assets. Here, check that the total assets per your balance sheet are equal to the total assets from the company general ledger. Investigate and resolve any differences you find. Part 3 of 4. Preparing the liabilities section. Determine current liabilities. Current liabilities are liabilities that are due within 1 year of the balance sheet date. Number 2. Calculate all long-term liabilities, also known as fixed liabilities. These are any liabilities that will not be settled within 1 year. Number 3. That the current liabilities subtotal the long-term liabilities subtotal. Label this line total liabilities. The balance for total liabilities will be shown on the second part of your balance sheet and will be added to the owner's equity. Part 4 or 4. Calculating owner's equity and totals. Calculated retained earning. Retained earning are the amount of profit a company has earned for a particular time period. Calculate the owner's equity. Equity consists of contributed capital and retained earning. Here, make a list of all the equity accounts like common stock, treasury stock, and the retained earning number from step 1. 3. Add the total liabilities and total owner equity figures. Title the sum, total liabilities and owner's equity. The balance sheet has been correctly prepared if total asset and total liabilities and owner's equity are equal. If this is the case, then your balance sheet is now complete. If balance sheet does not balance, double check your work. Last, you have to ensure that sum of the total is balanced. What the benefit for you watching the video? The benefit for me is knowing that the balance sheet must be balanced. Number 4. What is the title of the video? The title of the video is Financial Accounting Income Statement. B. Who is the speaker in the video you watch? The speaker in the video I am watching is Matt Fisher. C. What does the video tell you? That video tells about income statement. Explain the contents in the title of the video you watch. Income statement is a company's financial statement that indicates how the revenues is transformed into the net income. The income statement can be prepared in the one of two methods. The single-step income statement takes a simpler approach, totaling revenues and subtracting expense to find the bottom line. In addition to the single and the multi methods, the income statement can be reported on a cash or accrual basis. In income statement, report on a cash basis is typically used by smaller business that record transactions based on the exchange of cash. The revenues and expense reported reflects cash received on sales and cash paid for expense for the accounting period. Income statement should help investors and creditors determine in past financial performance of the enterprise, predict future performance, and assess the capability of the business to generate future revenue stream through the reporting in income and expense. A. What the benefit for you watching the video? The benefit for me is I know how to calculate income statement. Number 5. What is the title of the video? The title of the video is Introduction to Accounting Part 1. B. Who is the speaker in the video you watch? The speaker in the video I am watching is Kimberly Jang. See, what does the video tell you? The video tells about an intuitive approach to accounting. D. Explain the contents in the details of the video you watch. First, an intuitive approach. What is accounting? Accounting is the language of business. Why do business need to communicate? Why does accounting exist? What kind of decision can accounting help people make? All depends. There are 3 types of accounting including tax accounting management, accounting, and management accounting. Tax accounting. Most people think of tax when they think of accountants. Tax accounting helps determine how much is owed to the government for tax. Tax is a small part of accounting. Management accounting is designed to help people in business make decisions. Financial accounting designed to help people outside the business make decisions. Accounting brings it together in the language of business, including people and the process of capturing, summarizing, and reporting information about a business. Help people make decisions, including the main areas of the 3 types of accounting above. Why is accounting cool? People who understand accounting, understand business, and have tools to make better decisions and more information. Accounting rule the world. E. What are the benefits for you? Watch the video. The benefit for me is knowing intuitive approach. Part C. Why is accounting a great course to study? Accounting is a great course to study for a number of reasons. Accounting provides you with skill and knowledge that can be applied to a number of industries. In fact, so long as there are business in the world, accounting will always be needed. Number 2. What do accountants do? There are many qualifications and jobs that deal with money. So how exactly does accounting differ from other types of finance-related roles? Perhaps the easiest way to describe it is that accounting involves dealing with real revenues, actual transactions, and observable financial. Number 3. Why is accountancy is a good foundation? Even if you did want to branch out into finance and economy, a background in accountancy laid the valuable groundwork from development broader monetary theories. Accountants can hone their craft through the application of known methodologies. Number 4. What must you have when you want to study accounting? When studying accounting, you will acquire knowledge about the laws that govern business, typical business administration schemes, the ethics of accountancy, statistics, and accounting theory. You will be taught how to prepare the key documents that your job will involve, including business proposals, financial statement, and tax return. Number 5. Is accounting right or wrong for you? Accounting could be right at your alley. However, if you like a role that is constantly shifting and requires more speculation and risk taking, you may want to try other financial roles. Number 6. Are you sure that accounting will help you in the future? You can't really go wrong with a diploma of accounting. Even if you decide to switch career later, you'll have a great foundation understanding of how money is recorded and reported that will only help you in the long term. At the very least, you know how to manage your own finance better. Why does accounting have a good prospect of job in the future. Jobs in accounting are always in demand, and the skills you will learn through studying and transferable and can be applied to many other disciplines. Okay, enough. Thank you.